Philipp, welcome to the Ecom Crew podcast.
Hey, Michael, it's good to meet you.
Great to meet you as well. We're doing this series on aggregators in the FBA space, and really thrilled to have you on. Maybe to get started, it'd be good to just give people a quick intro to who you are and who your company SellerX is.
Yeah, absolutely. Very happy to. So my name is Philipp. I'm one of the two co-founders of SellerX. I'm from Germany originally, but spent the last 22 years abroad. Spent 10 years in the UK, finished high school there, went to university there, then started my career at Goldman Sachs in a group that invests the bank's own capital really in interesting opportunities. Did a lot of growth equity investments, a lot of investments in family-owned businesses. That was from 2004 to 2008. And then I moved to the US in 2008 and got an MBA at Harvard Business School. That's where I met my co-founder Malte for the first time. And we had 2 fun years in Boston together. And then I moved down to New York afterwards and lived there from 2010 to 2020 for 10 years. Great 10 years. First built a business in the education sector with another classmate of mine. We started that business really in our living room. We were roommates at the time and had the first few team members come to our living room every day, and then scaled that business relatively quickly to around 200 employees. Wow. I was running that for 5 years. My co-founder is still running the business today, but I have spent the last 5 years focusing on rollups. So looking at fragmented sectors where you can buy lots of smaller businesses and bring them together under one roof. Not just e-commerce businesses, but also other businesses and other spaces, including healthcare services. Basically buying businesses that, are family-owned, founder-led, doing anywhere from 1 to 10 million of revenue, and buying them, aggregating them, and putting in place processes, systems, technology to help make them run more efficiently and accelerate the growth. And then in March of last year, I was still living in New York. I went on what I thought would be a 4-day ski trip to Switzerland, and that was the weekend when Trump initiated the travel restrictions from Europe back into the US. So I found myself stranded in Germany for the next few months, and then spent a lot of time with my parents, which was the silver lining for me for COVID, but still felt a little weird being in your late 30s and basically moving back in with your parents. But here we go. That's what I did. And that was around the same time when Malte, my co-founder, was back from Brazil. He spent 10 years after the MBA in Brazil, where he built the leading platform, e-commerce platform for fashion and lifestyle products, a platform called Dafiti, the equivalent of Zappos in the US, if you will, or Zalando in Europe. They grew that business from 0 to 3,500 employees, more than $1 billion of sales, and ultimately took it public as well. And he was doing that as chief commercial officer, and subsequent to that, bought a business, became a seller himself on the Brazilian marketplaces, and also bought a beauty business. So he found himself back in Germany. We looked into the e-commerce sector closely and realized that there was a huge potential to build a great business in this space. And also Malte and I, we have very complementary skill sets. Myself more on the sort of investment, finance side of things, and Malte with a deep expertise in e-commerce and operations. So we said, let's give it a shot. And then we're now sort of 13, 14 months later. I guess we're talking here today.
Yeah, here we are. So how many deals have you guys completed so far?
We've done over 30 deals.
Okay.
The first
Very
deal
cool.
we did in October last year.
Okay. So it's been about 11 months or something like that. And so you're doing like 3 a month. You guys are moving right along.
Yeah, it's scaled up. Initially it was one, and we're now doing a bit more. But yeah, it's scaled up pretty quickly.
So when you a year ago when you were thinking about getting into this, what was so appealing about Amazon FBA businesses? And obviously there's a lot of other aggregators in this space. Everyone's kind of flocking to this. I mean, what makes this so appealing from your point of view, especially with as much background as you have in this? Yeah,
I mean, generally what I looked for over the last 5 years, well before starting SellerX, was industries, sectors that grow, that have great sort of, from a macro perspective, great sort of trends, growing, are sectors that you would bet on for the next 10, 20 years. And I think e-commerce it's very hard to find any research paper that sort of says that e-commerce is going to shrink or is going to stop growing. Yes, last year was clearly an exception, and if anything, clearly accelerated that growth. But overall, if you want to bet on a sector, I don't think you're going to be wrong betting on e-commerce. So that's important. Point number one. Point number two is it's a very fragmented space with lots and lots of smaller players, and that sort of lends itself, to some sort of consolidation, aggregation. And then number three is there's through the FBA model clearly a business model where you have a little bit less complexity and are able to, buy businesses at a larger pace. For example, I was doing a few roll-ups in healthcare services, which is an interesting sector as well. I think has a lot of growth, and it's so fragmented as well, but it has a lot more complexity, especially around people. Dental clinics, any sort of doctor labs. There's so many people that introduces a lot of sort of complexity, a lot of staff. With FBA, Amazon takes care of a complex part of the e-commerce business, which is so obviously the fulfillment. So you're able to sort of scale those much quicker. And then the last piece is that it's also a sector where you can really add more value and do, if you sort of work out the operations and build strong capabilities internally and strong technologies, there's value you can bring to those businesses and really accelerate the growth post acquisition on Amazon as well as off Amazon. So those are really the key four factors that made this such a compelling sector for us, but for a lot of other folks as well.
Yeah, it is crazy just like how many people have relatively quickly flocked to the space. I mean, I think that everything you said makes sense. I mean, it's one of the main reasons that we're in this space ourselves as sellers. But the one thing that always stresses me out about this space is that, even though Amazon does take care of a lot of the complexity, and we've been on both sides of this fence, we've had our own warehouse and ship orders out the door ourselves and really appreciate how easy Amazon does make it. But then the flip side of that is that you're in their sandbox, and at any point in time they could just be like, well, the referral fee is now 20%, or we're going to change our storage limits, or we're going to change advertising in some way, or we're going to just suspend your account, or anything on the list of things that can kind of go wrong, which kind of gives me the chills. Is that something you guys think about, but just kind of think about it at scale? It's not really that big of a problem, like over 30 brands. Yeah, if one of them has a problem, so be it, but the chances of everything kind of going down the tubes is pretty small.
Yeah, we're not losing any sleep over that, because also, and it's, by the way, a question that pretty much any investor that I've ever spoken to has brought up as well. It's clearly something that we spend a lot of time thinking about, but fundamentally, this trend, what we're seeing with aggregators acquiring Amazon sellers, is, we believe, and what we've heard, is in the interest of Amazon, because for a few reasons. One is essentially professionalizes the sellers. It ensures that because what does Amazon want? Let me take a step back. Amazon wants happy customers, offering high quality products at the best prices. That's what Amazon wants, and the aggregators are sort of meeting that goal by professionalizing and continue to grow them. They're well capitalized, so they will increase the stock availability, reduce stockouts, which is in Amazon's interest and the customer's interest. Do sort of more, in some cases, more rigorous quality checks, really ensuring that the quality, that the products are of high quality at good prices. And then FBA, Amazon is in control of the fulfillment and the customer service around that. It's sort of in their interest as well if these aggregators continue to do that. And then beyond that, point number two that I find very interesting is Amazon is keen to attract more sellers to its marketplace, to increase the selection. And there's no better advertising that Amazon could do than to showcase sellers that have started successful businesses on Amazon and were able to exit and cash out and have a liquidity, which in and of itself will attract more sellers to the platform. Because if you come to Amazon, you have a great product, you scale successfully and then have an exit. I mean, you can make a lot of money. You can have a great outcome in a relatively short period of time, which makes Amazon's marketplace even more attractive for more sellers to enter.
Mm-hmm. Yeah, that makes a lot of sense, obviously. So the majority of your deals to this point, I mean, is it people coming to you? Do you have friends out, feelers out all over the place? Do you kind of cold call and knock? One of those people that send us emails every day that's we're interested in buying businesses. I get like 12 of these a day now, it feels like, from various aggregators. Like, where does most of the deal flow come from?
I mean, it's a combination of everything that you just mentioned. A lot of inbound, and that's a function of building a reputation in the market, having some credibility, having closed a number of transactions. The seller community in some cases is very small. People talk. If someone had a successful exit, they do talk. They talk about who the buyer was, what the experience of selling that business was. Was it sort of a fair, transparent process that went on, that was done so pretty quickly and smoothly, or did it not go as well, or did it not even conclude in the worst case scenario? So reputation is tremendously important, and we place a lot of value that to really become a seller-centric buyer, and that's also how we chose the name SellerX. The X is sort of that variable that describes our sort of ability to customize things to each seller, and recognizing that each seller has different motivations, different incentives, and different circumstances, and trying to sort of customize a tailor-made sort of solution for every seller. So it's a lot of inbound, but also we do reach out as well. We try and be considerate, and I don't think we do. Bombard sellers. We don't do sort of any mass outreach emails. It's really, we identify specific categories, specific niches that we really like. In some cases, we already own a brand and like to sort of add another business that we really like, a lot of portfolio of products to our portfolio, and then we would reach out in a very targeted way. And then you do have a network of brokers as well. A lot of them have popped up as well, probably just as many or even more than there are buyers. There's just as many, if not more brokers that we also make sure we have a good relationship with as well. So it's lots of different channels that we get great targets from.
Yeah, and I definitely think the word of mouth thing is where the majority of this is going to probably come from over the years to come. I mean, I'm speaking at Rhodium Weekend, for instance, tomorrow. Actually, we're recording this right before that, and it's just, you're in a room with 300 people and everyone's talking, and a lot of people have exited. And how did it go? Well, it was a great experience, or it was an awful experience, and if it was awful, you'll probably never get anyone in that room ever to deal with you ever again. And same thing with like e-commerce fuel or MDS, these types of communities. And there's been a lot of deals that have closed, and people are discussing them, and the ones that have gone well, I think, are just easy word of mouth for getting the next deal.
And by the way, that's what I would recommend any seller to do in any case. Get some references. Talk to other folks who have sold to a particular buyer and see what their experience was like. Don't just talk to a potential buyer and believe them. Do your own research. Talk to other sellers who sold to that particular buyer.
Yep, absolutely. So, what's like the ideal business that you guys are looking for? I mean, if you were to kind of, on the back of a napkin, kind of sketch out what you're looking for. I mean, it sounds like pure FBA. I mean, are you looking for things that also have a Shopify or other presence, or do you want things that are exclusively FBA?
No, on that we're flexible. The majority of our acquisitions so far have had majority of their revenues through some Amazon FBA, but there are some acquisitions that we've made that have a sizable portion of the overall revenue through either sort of FBM in some cases, but also in others also off of Amazon. through Shopify as well. So we take a pretty flexible approach and are open to non-FBA sellers. Having said that, the majority of acquisitions have been sort of FBA sellers. In terms of other criteria, we're flexible in terms of size. We acquired businesses from as low as just under $1 million of revenue all the way to 30 million plus or 40 million plus. So it's a wide spectrum. There's categories that we really like, that we've identified. A lot of them fall within most of them within those evergreen product categories that I think a lot of buyers go after, things around the household, garden, pet supplies, health and beauty, fitness, things like that. We do look, for categories we want, look for some growing niches that we take a view on. We do a lot of work to figure out, take a firm sort of opinion, a strong view on specific sectors or categories, and an ongoing trend in those categories. And then we do, obviously the quality of the product is key, which can be assessed through the ratings and the reviews. That's absolutely critical, because that's very much the core of what you buy is the product. And then last but not least, it's profitable businesses.
Right.
We look at a contribution margin 3, which is revenues minus all the variable costs, and we want that margin to be above 20%.
Got it. Okay. Makes sense. And so are there any types of things that you avoid? I mean, is it like big, heavy items or a particular, adult toys or something, or whatever? Like, are there things that you guys have just kind of identified as off limits for your portfolio?
Yeah. I mean, heavy, bulky products is we don't categorically sort of exclude that, but the bar is significantly higher. Fashion, unless it's very basic, we generally avoid. Consumer electronics, same. We're not so too bullish on. But outside of that, we're opportunistic. There's certain categories that we've identified that we like, but we would look at a lot of these other sort of evergreen product categories.
Gotcha. So how do you guys stand out from the crowd? I mean, one of the things that it's kind of dawned on me as I've seen all these emails come through, it's all kind of the similar pitch, right? It's like we buy businesses, we'll help you cash out, we'll pay top dollar. But again, the message is kind of similar from a lot of people. So what do you guys do to stand apart from everyone else? Yeah,
I mean, a lot of players are funded. There's capital. I think the way you differentiate is in a few ways. One is, and I would put that very highly, and categorize that under sort of just people, the team, because it goes from anything from the operational capabilities that you have, the operations team that's sort of behind then growing the brands once you acquire them. Because I don't know what you're seeing, Michael, but most of our deals have a portion of the purchase price comes in the form of an earnout that's linked to the future growth of the business. So in that case, it is in the seller's interest to choose a buyer who has a great track record, has a strong team, a credible team, and is in a great position to maximize the growth post-acquisition. Clearly, a lot of us, including us, are not that old, but there's still now, with more than a year of history, there's sort of a track record that you can build. You can point to sort of case studies. What have you done to brands? How have you grown those businesses on Amazon as well as off Amazon? What have you been able to achieve? So I think that's sort of one part of the business. And we do have an operations team. Just the operations team alone is close to 200 employees in our case already.
Wow.
Then that's across marketing, supply chain, customer service, content, brand management, all those areas. And then it's also the technology that you build, basically your capabilities to grow. What can you do with the businesses? A little bit similar to why an investor would invest in a SellerX or in any aggregator. What do they look for? They look for sort of the strongest team that can execute and can achieve sort of growth of the businesses that you buy. And that's really what we focus on. We see this as a consumer business, and that's sort of the DNA of our company. Is sort of operations matter, technology to building great brands and businesses. That's what we focus on. That's sort of the DNA of the business. We don't take the sort of finance approach that just buy up lots of businesses and then we figure out what to do with them. We really see this fundamentally as a consumer business. And then I think it's the reputation that I mentioned and the credibility, the ability to run smooth, fair, transparent processes and get them to conclusion, because that's also what the sellers then rely on. Once you sign an LOI and are in exclusivity and do your due diligence, the seller wants to get that done quickly, and also doesn't want to deal with a buyer who renegotiates last minute, drags things out. It's just a pain in the ass to deal with.
Yeah.
It's always a little bit painful. I mean, there's no due diligence that's just done like that.
It's always going to be a painful process.
It's always a painful.
No one ever looks forward to their proctology exam. So
exactly. But you can make it less painful as a buyer,
Yeah.
and I think a lot of that comes also with experience. Prior to as I mentioned, prior to starting SellerX, I have acquired more than 100 smaller businesses. There's a lot you can learn that you do learn from doing a lot of these deals. And you figure out a way to streamline those processes to make them a little bit less painful. And you also, most importantly, really focus on what matters. There's lots of things you could also diligence, but there's several things that really matter, and let's focus on that.
That is one of the great things about an FBA business, is it is definitely a lot easier to diligence than a non-Amazon business or just other businesses in general. I mean, you get access to the Amazon account. The data is impossible to fib. And then it just really comes down to making sure you understand what COGS are and any other expenses. But most of these businesses, run relatively simply. I mean, it's not, overly complicated business, and that's one of the great things we're kind of talking about. Amazon makes it so easy because you don't have a warehouse, you don't have employees doing pick, pack, and ship, and you don't have all the other expenses that you can kind of start to sweep some things under the rug, or kind of make the pile of poop look like a rose a little bit more. I mean, it's kind of hard to do that in the world of pure Amazon FBA.
True, very true, absolutely.
So I'm sure, I mean, I'm just taking a guess here, that every deal is a little bit customized in some way. I mean, I think, in order to get things closed, there's always, you got a little give and take here or in there, or whatever it might be. But what's like the basic framework that you guys use? If someone was looking to sell their business, you mentioned there's an earn-out component. How do you guys structure, again, like at a top level? Like, what is the kind of the going multiple? What's the blend between earn out to cash out? How do you guys handle paying the inventory component? Again, the basic framework before you start negotiating. What does that look like?
Yeah, we try and keep things pretty simple. There's basically three components. One is, and we value the businesses, I think, which is sort of commonplace in this space, based on sort of the STE multiple on a STE multiple last 12 months typically, and you put a multiple on that, and then a portion of that, the biggest portion is paid up front. I think that's what a lot of sellers want to see. A lot of them, not all of them, but want to sort of take the chips off the table and get the purchase price up front. We add the inventory at cost. We pay one for one for that, unless it's sort of inventory that's crazy sort of aged and just been sitting in the warehouse for like 3 years, and no one would buy it. But generally pay for the inventory one for one. That's sort of the biggest portion is up front, and then there's a small portion that's deferred by a year, sometimes 6 months, 6 to 12 months, where that's linked to just revenues not declining. We don't want the business to sort of fall off the cliff. Something really bad happens that we missed. So that's sort of a little bit of protection. Very much. We have we expect to pay that in every single situation, and there's not one business that we have acquired where I do not expect us to pay that. And then the third is an earnout that's linked to growth, which is a percentage of the future contribution margin that's generated by the business post acquisition.
And is that perpetual, or is that like have a finite amount of time on the earnout part?
That comes down to negotiation. It could be anywhere from 1 to 2, typically 1 to 2 years.
Gotcha. Okay. And you said the bulk of the cash up front. I mean, what is it, 80-20, 90-10? I mean, what's the typical?
Probably around 80-20.
Yeah, that's usually what I kind of been hearing a lot. And then on the inventory component part of it, you said you pay 1 for 1. Is that typically like right at deal closing, or is that paid off over time? How does the inventory?
No, we typically pay that right at deal closing
right
as
at
well.
Closing. Got it. Okay. Excellent.
I guess you're bringing me sort of up ideas that maybe we shouldn't do that, but no, we do that always right at closing for the inventory.
And I've just, I've seen things get creative, right? I mean, I think that, again, everything's kind of give and take. I mean, sometimes people are looking for a higher multiple, for instance, or maybe they are looking for more cash up front or a larger long-term equity piece or some other, thing that's important to them. And then maybe they're willing to take a note on the inventory. For us personally, I mean, I can just tell you for the last deal that we did a note on the inventory and got paid for that over the next 12 months. But I think that it helped kind of get the deal closed and helped with some other stuff. We also got some interest on that, which I was happy to get. So, I mean, everyone's in a different position. Some people just want the cash and want to go buy a boat or something, whatever. Yeah. And for me, it wasn't just about, getting the cash, but I was looking to immediately knew I was going to try to invest the money in something. And, I understand, with a lot of buyers that, the inventory is an expensive component. You then have to go buy more inventory to make sure that you don't run out of stock. And so it's another cash hit. And, they just happened to be the people that we were working with. They were looking to just kind of keep their cash flow in check as well. And it was a win-win for everyone. And so it was just something that kind of came up afterwards. I just was kind of curious, like what the standard operating procedure for you guys was. And again, I think that's why I said, I think a lot of it's probably, there is no exact deal, right? I mean, I think that every deal is a little bit different because it depends on the buyer and what they have and what their business is and how strong it is and how much leverage they have, et cetera, et cetera.
Yeah, no, absolutely. And that's what we've also explored, again, is to sort of continue to be creative, is to have sellers roll some of their shares in their business in post-acquisition into their business where they, sell that, at a later point, and potentially even roll some of that into the combined entity, into SellerX, and have a piece in the buyer and benefit from sort of the continued growth. That's typically we would do that in situations where also the seller is keen to stay on board beyond sort of a transition period and really wants to take a more active role in the business going forward.
Yeah, and I think that's got to be one of the hardest things for aggregators that just do a complete buyout and the owner just disappears. I mean, trying to find the talent to run these businesses post-acquisition, like that's what kind of gives me a headache thinking about, like, from your guys' position having to do that. I mean, it's really hard to, you think about the number of people in the world that are entrepreneurs that can run these types of businesses and have, the criteria that you got to be a little bit crazy. You got to be able to not be risk averse. You got to be able to juggle multiple balls and like you're innovative in some way and made these products. And these are just traits that are hard to find. And you lose that, right? I mean, it's like that person just disappears. Like, how do you continue to run the business at that same excellence level? I mean, we've just purchased another business ourselves, and it's hard to imagine you having like 10 of these under our roof, and trying to replace the old CEO. That's the part I would say would be the most difficult.
Yeah. I mean, we have an onboarding team that basically manages the transition and over the first 90 days post acquisition, and then it sort of gets transitioned to our brand management team. But the good thing about sort of building up a structure is, yes, there's sort of a brand owner, and you need to find great people who basically own the brand, run the brand, are responsible for the P&L and cash flow of a brand. but then you can leverage, that person can leverage sort of our entire infrastructure that we're building, whether it's a content team and supply chain team, demand planning, supply planning, marketing, content, customer service, all these things they can sort of leverage. And there's a lot of expertise that gets built within the team that each sort of brand owner can tap into to maximize the performance for the brand. But yeah, I mean, you need great people. And they're always hard to find, and that's so a big part of what we do. Also, what I spend a lot of my time on personally is recruiting, is finding great people to join and help us on this journey.
Makes sense. Yeah, I could definitely, and it's I think harder than ever trying to find these people. I think the employment market's just nuts right now. It's kind
True.
of an interesting time in the world.
Yes, it is.
Just a couple quick things to wrap up here. I want to be respectful of your time. We're already getting kind of close to being overtime here, but I'm interested in like what the end game is for you guys. I mean, I've gotten a lot of interesting responses from going public to taking the whole thing and reselling it to a roll up and kind of doing multiple arbitrage. I've gotten responses of we plan on keeping this long term as just a cash flow generator for investors that are looking to get a better return than they can in the market. I mean, what is it that you guys see as the 3, 5, 10, whatever year plan down the pike?
Yeah, I mean, for now we're clearly laser focused on building a great business and growing it, and not spending too much time thinking about an exit. Having said that, we also are mindful of the fact that we do have investors that have backed SellerX, venture capital investors, growth and private equity investors, who have invested their capital into SellerX also to generate a financial return, and to realize that does require an exit. And the most likely scenario here is, in my view, is an IPO, is going public, which once you reach a certain scale is a very sort of feasible path in our view.
Yep. So last question I want to ask, and I'm not trying to put you on the spot or make it uncomfortable in any way, I promise. I just something I've been thinking a lot about. You think about like market cycles. You see this in college textbooks. You see it in practice in real life. There's some sort of a cycle that every market goes through, and towards the end of the cycle is like when all the money rushes in, when all the big players come in, and the repercussion of that can be good or bad. And I'm still trying to figure out exactly how all this ends, for for us as sellers, for consumers. At some point, I'm sure there'll be 3 to 5 to 10, whatever aggregators kind of standing on the top of the mountain as the big boys that have acquired the most businesses and become a multi-billion dollar aggregator and have a lot of brands under their roof. How do you see it playing out in terms of like how this works out for small sellers? I mean, it feels great right now, right? It's a great seller's market, and all of us are, I think, in a great position to sell our businesses because there's just so many more buyers than the other way around. But at some point, I can't. And I don't know the answer. I'm just still trying to figure out. But I'm just curious from your point of view, like what the repercussions of all this are 1, 2, maybe 3 years down the line.
Yeah, it's a great question. I mean, I wish sort of I had sort of a great answer here, but this is sort of how I see this, and similar to what you said. I mean, I do expect it's a huge market, so there's going to be more than a handful of successful players, aggregators that will have a great portfolio of brands under their roof. But it's not necessarily just those that acquire the most businesses. I think what will be more and more important is, and it's sort of stating the obvious, is the quality of the assets. And this is something I think right now you'll see most sellers, I think, can find a home. And I think that will change. And buyers will become more disciplined. You will see some aggregators acquiring businesses that are not continuing to grow.
Yeah.
And if you also, we've seen some portfolios already. You start to see the early signs of a consolidation. There's some portfolios that have hit the market. And there's some that are great portfolios, but there's others where half of the brands have been declining for the last 6 to 12 months. And it's a very competitive market. Margins are compressing, and it's a tough situation to be in. So I think from a seller's perspective, as long as you focus on having great products, building great products and brands that also maybe a bit differentiated, I think there would always be capital. There would always be an exit opportunity for those sellers. I do think, though, that some businesses that are sort of maybe hyped just by Corona, that is as we would all hope, is sort of a one-off event, and have sort of rode that wave, and don't have a fundamentally solid sort of product, and not a great sort of business, I think it'll be harder for them. But anyone who launches great products, grows them, gets them to a certain scale, shouldn't worry, in my view. There will always be capital, even if I completely agree. There's got to be a cycle. That's one thing that everyone knows for sure, is that there is a cycle. No one can predict sort of the timing, and I'm not going to make any predictions here. But it's not going to continue forever. That's for sure. History has taught us that. But how long it will continue like that, who knows? But one thing that I do know is that there will be successful players coming out of this. Those will be those that are disciplined, have selected great assets, and have the capabilities to grow those businesses. I think that operations, that's what it comes down to. And then sellers that have great products that they sell on Amazon and other marketplaces or through Shopify, etc. There will always be exit opportunities. There will always be those sort of buyers and others that will gladly acquire those businesses.
Yeah, absolutely. Agree. Great insight. Appreciate you. Let me put you on the spot a little bit there for that one. Can't thank you enough for coming and doing this. If people are listening and are interested in potentially selling their business to you guys, what's the best way to get a hold of you or SellerX?
Yeah, no, I think would love to hear from anyone. Best way to get a hold of me is just to email me directly. Always love to hear from sellers or anyone else in this ecosystem. Email address is philipp@sellerx.com. It's philipp@sellerx.com. Great talking to you, Michael. Really appreciate it.
Definitely. Thank you so much, man. I appreciate it.
Bye-bye.